worked with Hawkeye Traders for a little over 2 years now. Nigel Hawke saw me present at the Australian Technical Analysis Association about 2.5, 3 years ago nearly, and said we want some of that. We haven't got an options arm, so to go along with our Forex equities and futures. So so that's where the relationship started, and I was blown away by the strength of volume spread analysis, which I'm going to talk about in a moment. Originally from the UK, you'll notice that it's possibly an unfamiliar accent to many of you. And now live in a beautiful part of the world, in just outside of Perth in Western Australia. We're heading for 40 degrees Celsius. That's, I don't know what the, in American temperature, I don't know what that is, 100 and something today. Obviously we're in the middle of summer this side of the planet, so Santa's wearing his shorts and his sunglasses and tromping around at the minute. And look, part of my job as a teacher is to do my best to give people information, people like yourself, to take you to the next level of trading. So that's what I do it for. Just if you want to make a note and ask me any questions going forward, it's mike@hawkeyeoptions.com. So that's a little bit about me. I've got a little bit of information about you in terms of where you're coming from as an options trader. So let's really get into the content of the session. So really, if we look at trading success, the bottom line is that many people get fixated on entries, and although entries are a part of the picture, they're not the whole picture. Really, the only purpose of entry is to find trades that give you a high probability of something going in your direction for a period of time, no matter whether that's a few minutes or a few hours or a few days or even weeks, depending on your particular vehicle and depending on your particular trading style. Entry does not necessarily determine profit, sexy though it is to put on a heap of colourful indicators and to get very caught up with this. And also I want to say that as part of your measurement, you should not just be looking at win-loss ratios. Profit-loss, win-loss are important, but more important, particularly when you're directional trading, is your average win versus your average loss. Okay, so bottom line is, it's not the entry, it's what you do next that really counts in terms of your sustainable success, which is obviously what most of you want with this, that really counts. So in combination with high probability entries, we want to have timely exits, and in an options context, that doesn't just mean in terms of how we set initial stops and trail stops and profit targets. All of those things should be articulated within your trading plan, but also we've got the issue of time decay. We can legislate for that a little bit when we're deciding which option series we're going to invest in. And of course, it'll also depend on whether we're after a net debit sort of trade, such as a bull call, or we're taking advantage of time decay through doing something like a credit spread, which we'll talk about later, because I know that's of interest to many of you, weekly credit spreads. But that isn't the dynamite strategy I'm going to put in front of you. So when you'll have seen that we talked about 250% last year. A slightly harder year this year. It's going to end up around 3 figures, but it's not 250%, but that's because it hasn't been a directional market for the whole of the year. But just to illustrate some of the points that I've been making, if we looked at the win-loss ratio for that, then it was 28 to 27 win-loss over 55 trades done. Here's the kicker. The real difference was the average win versus the average loss. The average win was 64% in terms of our original investment. The average loss was 21%. So if we take those two figures, you can quite easily see that all you have to do is get 1 in 3 right and you're in a winning situation. You make it 50-50 or 1-to-1, then of course you're going to start hitting the big numbers on a sustained basis. That's what it's about. So that's really the essence of what makes a good trader. Now, if we're looking at something like credit spreads, then something like win-loss ratio does become vitally important, and I'll explain about that later. One of the key differences that I've noticed in the one-to-one coaching that I've done over the years, looking at my own trading, looking at the differences between those who did very well and those who perhaps didn't do as well as they hoped, one of the other crucial factors in your jigsaw of what makes a great trader is matching strategy to market. There is no one strategy that suits every market conditions. That's the reality. Okay, if you trade directionally, don't adjust position sizing in a market that we've had for most of the year, then you're going to get hurt if that's all you're doing all of the time. So the bottom line is, if you want to be a successful trader, then of course there's advantages of options over other vehicles in terms of you can trade any market direction, but it is a skill you must learn, that matching strategy to market. Otherwise, you'll fall short of what your potential is. So we talk volume spread analysis, and really we're going to run some additional sessions on this for those of you who want to take it further, but I thought it was useful just to put it in front of you to illustrate what volume spread analysis is all about. Really, if you want to determine, if you want to give yourself an edge in the market, then really what you're wanting to do is try and give yourself a little bit of an edge. And VSA attempts to do that. And it's based on the principles that if you an underlying equity, an underlying asset, moves according to supply demand in the market. And you want to see that visually, and you need to look at volume. The second point is that this volume may be buying or selling volume. And you'll see on this chart I've got here, the volume is the second bottom row, and we've got not only the amount of volume, but also three different colors. Red equals selling volume, green equals buying volume, and white equals neutral volume. And this is one of the things that Hawkeye software is based on. So the issue is, if you combine that knowledge of whether it's buying or selling volume and then look at price too on the bar related to that, you can try to give yourself that trading edge, which is going to give you high probability trades, excuse me. So we're comparing trend and volume to make decisions in terms of entry and exit. The issue with using VSA is, and the edge that you get, is it often gives you a heads up that something is about to change. And that can put it on your radar for when there is actually some entry criteria there, you can dive in and place the trade accordingly. So often we'll see a change in volume before we see a change in trend, and that's why volume is considered to be a leading indicator and not lagging indicator. And of course VSA is used across all vehicles. Now if we just have a look at I just picked a random chart just before we started. So here's AT&T. So just to explain a Hawkeye chart, we've got a trend which is green trend is uptrend, red trend is downtrend, and the white dot means it's in congestion. There's complex algorithms go behind both creating the trend and the volume, whether the volume is buying or selling, which we'll go into in another session. But you can often, one of the strengths of this is that you often see, as I said, the change in volume before we see a change in trend. So if we look at this downtrend here, for example, what we see is the downtrend starting to lose a bit of steam, and there's the buying volume coming in, as many as 3 bars before we actually change to an uptrend. If we look later on, if we look here, for example, although we're in congestion here, we saw the selling volume coming in here, which said, hey, look, this might be on our radar. Likewise, again, if we look at the next uptrend, you'll see sort of mid-November, you'll see the buying volume coming in, the green volume coming in before we get that green uptrend. So again, we can take advantage. So it's the combination of these factors which give us a trading edge, and why volume spread analysis is so powerful. Additionally, of course, we want to be sure we're trading with the market, not against the market, because invariably if we try to trade against the market, it doesn't tend to create a satisfactory outcome, much as though we need to, much as though some of us believe we can feel the market. We really want to see if we want high probability trades, we want to see buying volume across multiple time frames. So just to give you an example, for directional trading or short-term weekly option spread trading, we often use the 1 day, 2 day, 1 week combination. And for longer spread positions, including diagonal call spreads and the explosive strategy I'm going to talk about today, we'll use the daily, weekly, monthly combination. For example, if we're interested in ABL, this was a trade that was in our alert portfolio service. You'll see here, we've got a 2 day and all through chart. That we have to get in on this. Okay, so I mentioned strategy is pretty crucial. So trading against the market is pretty tough, and with options trading, of looking at volatility is key to selection. So generally speaking, the market can be going up or down, and can be low volatility or high volatility. And each of these combinations creates a set of strategies which are best used for specific market conditions. Now, there's all sorts of things we can look at, but by simply using the S&P 500 and the VIX, this can give us huge clues as to which strategy could be most suitable. Questions in a moment. If we look at the S&P 500 in terms of where it is now and where it closed today, we're obviously in downtrend, so that would lend itself to not trading bought calls, but would lend itself possibly to puts, and also maybe some credit spreads. Now, we do have a little issue, of course, in that 2000 is a pretty key line in the sand on the S&P 500. You'll see it. It's had 2 tests over the last 2 days, had some buying coming in the last session, and so really that would sort of lend us, or that would sort of indicate to us that perhaps diving into a heap of put positions may not be appropriate for the right now. If we look at the weekly S&P 500, which next, you'll see that the S&P 500 is still in congestion. We're still trading within quite a wide range that we've really been in for much of the year. It looks as though we're going to finish down, but we've got a down for the year in entirety, but we are still in the state of congestion for the weekly. That would put a little bit of a red flag on our desire to get in puts, to accelerate, push our foot on the accelerator and get into many puts. So we've got to be cautious in terms of how we sort of act from here. It could be, of course, that we remain in congestion, and therefore spreads may be the way to play things. It is unlikely, of course, that we're likely to move back into uptrend. So really, for possibly for the next few days at least, until we at least see the daily S&P 500 move into at least uptrend, then we may decide that directional straight bought calls are off the table in terms of a strategy. So these are the things we can look at. Now then, we combine this with the VIX. If we look at the VIX, for those of you less familiar, the VIX measures implied volatility in options. Generally speaking, it's called the fear index because there's an inverse relationship between this and the S&P 500. As markets get anxious, then implied volatility in options tends to rise. And so we can use the combination of these two, not only to tell us which direction the market is going, how robust that move is, but also in terms of volatility, where may there be opportunities for high volatility strategies versus low volatility strategies. Generally speaking, low volatility markets suit longer term buy-in of options, and high volatility markets, as a general rule, favor the sellers. But that's not the whole story, of course. So looking at this, well, look, directional trading is probably out. We're not compelled enough to get into certainly bought calls, and perhaps not in any big way in bought puts. We might dip our foot in, but we might position size slightly less than we would normally do for a directional trade, and perhaps open 1 or 2 positions maximum in this sort of market. However, what we've got is, in terms of the year, we've got a relatively high volatility, which isn't going up. It looks as though it may start to come down. Now, this gives us an additional opportunity. And that opportunity may be credit spreads. So credit spreads are best placed in a market where some uncertainty exists. And generally speaking, there's not a strong direction to the upside. Strong directions to the upside tend to mean that the volatility in options tends to go down. And what that means is we are moving the spread closer to the action than perhaps we would like to. Just to revisit risk, there's 2 types of risk. There's actually the dollar risk if something goes against you and triggers a stop. And also, of course, there's the chance of that risk event occurring. What we're trying to do with credit spreads is reduce the latter, so reduce the chance of a risk event occurring. So the further we can take a spread, i.e. 2 options legs, away from the current price, the better. And we can either do a bull put spread, which is 2 put positions if we think the market is going to go up or sideways, or a bear call spread if you think the market's going to go down or sideways. And what we're doing is we're scalping net credit. We're placing the sell leg closer to the action than the buy leg, and hence we bring in more income, more premium from the sold leg than we do paying for the bought leg. We're looking for a short duration, but if it goes wrong, it can hurt, and that's one of the reasons why we need to have a solid exit strategy, which those of you moving forward with us are going to learn inside out, back to front. But also, it's why we tend to go shorter, and why we would prefer markets which give us a high probability of a credit spread occurring. So what our ideal market situation for a credit spread is high volatility, which is starting to drop. Now, earnings may give us an additional opportunity, but that's another story for another day. So we could be in the ideal market to set up some credit spreads, and we actually had a successful credit spread last week. That expired. Both legs expired at maximum profit on Friday in Microsoft. Here is Microsoft, and look, I just put this up really because we could be in for another opportunity potentially if Microsoft subsequently moves up again. Look for something that's 2 weeks and maximum 3 weeks to expiry, but you'll see that Microsoft looks as though it's going to move into congestion. We did that same volume the previous day, not surprisingly, on that drop, but we also had the crucial $54 support honored in that session. We had a session which was pretty strong, and if we get another move up, then we potentially would look to play it out credit if we're feeling aggressive, or even 53, 52 if we just wanted to scalp a little off. What that also gives us is a chance to be more aggressive or more conservative depending on our particular investment style. I'm just going to have a quick look at questions and answer any that have come through. Okay. So the purple bars that you see, to answer one of the questions, are what's called wide bars. Now this gives us an exceedingly high chance of success if we use these for credit spread trading. So there's a couple of rules that go along with this. The direction we're going, it's got to finish in, if we're going short a credit spread, so we're going a bear call spread, it's got to finish in the bottom third and usually be a continuation of trend. And if it's going to be a bull put spread we're going to place, then we're wanting it to finish in the top third. So we'll be looking at this in the last hour and deciding whether it was whether it was a wide bar, and B, where it's likely to finish. So just to give you an example, if we entered on this particular trade here, we put a credit spread perhaps at 45, 46, and we're looking for something that in the next 2 weeks doesn't land above the top of the wide bar, and you'll see that it didn't occur. We've got another wide bar here. We wouldn't enter another one on this because it didn't finish in the bottom third. Finished about halfway along the bar. Now, sorry, the wide bar is just a day of high volatility, of abnormal price action, and that usually means a couple of things which are important in other types of trading, such as directional trading. But for now, we're going to focus on the credit spreads. Now, if you haven't got Hawkeye, it's okay, because again, those of you moving forward, we're going to teach you how to do this with standard proprietary indicators, so it's no drama for you. If we look at the next wide bar, this we wouldn't have entered on because this was obviously a pre-earnings wide bar, but we may have entered on this one. But you'll see again, looking at the next 2 weeks, didn't finish below that. Looking at this wide bar here, this is interesting because we've got one wide bar finishing the other. If we look at this one, we could have entered a bear call spread at 56.57. That still wouldn't have been triggered in the next 2 weeks, so we could have entered on either of these. There we put a bull put spread. This is a great iron condor setup, by the way, for those of you more experienced. We could have set our bull put spread here, and again, it's traded within that range. Quite often with a wide bar, we see something trading within a range or continuing its trend. So if you look at the wide bars that I've shown you, then they've all been successful. Now, not everyone's going to be successful. We started doing this about a year ago. We actually did it because we wanted to show people how to develop a new trading system on a new using a new indicator. So we actually used this and taught people through it, and actually traded some trades within the portfolio, the Trade Alert portfolio service to mirror them. So, and what happened is we got an 8 out of 20 trades, we've got 18 wins, 2 losses. With credit spreads, you need at least a 3-to-1 win-loss ratio to make sure that we've got an ever-growing profit. And that's simply because if it goes against you, then, and obviously you've got to close out with a wide bar. We've got a nice little line in the sand. We close it if we're in a bear call spread. We'll close it if it breached the top of the wide bar, and vice versa. So the wide bar is a pretty powerful tool, but not the explosive strategy that I made reference to earlier. Nevertheless, we've got an on-demand course which you're going to have the opportunity to access, all about credit spreads, weekly credit spreads, and the wide bar, and how to use normal indicators, if you like, if you haven't got Hawkeye to do that. Okay, I'm looking at GE. Again, I put GE really because we've still got green volume coming in GE. It's been quite a robust stock despite the comings and goings, and I wanted to put a trade up that we're considering for the next session. So there's two ways we could play this. You'll see the pivot lows just under 30 there. So we might be tempted to place an aggressive 30.29 bull put spread on this, but more likely we might take advantage of it potentially remaining in the range. So what we're actually looking for at the next session is a butterfly trade at 30, 31, 32. So long call butterfly. What that means is we want it to stay between 30 and 32 until expiry. Again, we'll probably go relatively short term, maybe Jan 8th expiry. GE is great because it's a liquid option. The bid-ask spreads are pretty close together. So that might be the way we would choose to trade GE, which would cost us around about a 23 cent debit. That would be our maximum loss, and obviously the closer it finishes to 31, the better. We would tend to, with butterfly trades, just for your reference, we tend to look for a 70 or 80% return on investment. So wouldn't be shy closing that out if it gave us that before expiry. Okay, so there's a couple of things to have going to look at. So exactly, Julie, the Y-bar's a boundary, can be a boundary on the trade in terms of we're placing our spread or below, depending on which direction we're trading, and we're using as our. Now, one is a situation. Options, if you buy them, don't move one for one with the underlying share. It's all to do with delta, which is the generally speaking, an at the money call would move 0.5 of a cent for every 1 cent of the underlying. So if we had a GE trading at 31.30, sorry, at 30.31, then we would expect a $30 call to move half a cent for every 1 cent that the underlying GE moved. The other issue that this many of you will have traded covered calls. Just let me know. Just type yes if you've traded at or looked at covered calls before. Just type that in the box. Be really interested to know. Yeah, quite a few of you. Perfect. Okay, so you'll know that one of the issues with covered calls. So what we're doing here, guys, for those of you less experienced again, or maybe haven't looked at this for a while, we're buying a share position, and then we're subsequently selling calls over the top on a weekly or a monthly basis to generate weekly or monthly premium. So ideal for those of you who are not in a hurry, but just want to make sure that you're bringing in money every month. Problem is that covered calls are quite expensive. If you were to buy, let's say, 10 contracts of GE, to use the example that we've been talking about, then you'd be investing $30 times 10 times 100. So you'd be investing $30,000 for a position that may generate you 3% a month, say. So it makes it quite expensive. The other thing, of course, is we can protect using a put option to cover downside risk, but again, that's additional investment. So here's the thing. What if you could have exactly the same exposure as a covered call? So the underlying moves 1 for 1. You can still sell calls over the top, and you can put some put protection in. And the share, or having exposure to the share movement, costs you absolutely nothing, or pretty close to. Would that be appealing? And then you can sell weekly or monthly calls over the top. So what you've got is a protected synthetic share position, and then subsequently selling calls to generate your premium. This is what we mean by shares no money down, or as we used to call it, we ran a course on this a couple of years ago called Jaws, and was hugely popular. We don't run that regularly because we're very careful about releasing it too often. We don't want. We want people to do the learning, of which there's a substantial amount, to be able to do it and do it well. So let me show you. Just these are real. I've just taken these again. I've just taken these from. I just grabbed them from Google Finance before we started, just to show you a real example. So here's the June series for GE at 30.39. So as we've already said, if you wanted exposure for 10 contracts for this, then it would cost you $30,390. If you wanted 20, it would obviously cost you $60,780. Okay, so a relatively big investment. Now, on a monthly basis, if you make 2 or 3% and you do that regularly, then that's not a bad return for the year, and to be honest, will beat the returns that many traders get. So covered calls in some market conditions, and this year has actually been a good market for covered calls, are generally a strategy well worth having in your toolbox. Here's the thing. If we bought a June $30 call, you'll see that the last trade was at 163, let's say 165, give the market makers a little bit to play with. And then we sold a put option at exactly the same strike, exactly the same series for 160. The net debit on those two trades would be 5 cents. So here's the way it works. if the underlying share goes up, remember we talked about delta being 0.5, what happens is the bought call moves up 0.5 cent for every 1 cent in the underlying share. Because this sold put is a net credit position, what happens is that if we want to close that, we have to buy it back. And if the underlying share moves up 1 cent, then the value of that put option should drop by 0.5 cent. So 0.5 cent for the improvement in the put in terms of the buyback cost, 0.5 cent improvement in the call equals 1 cent. So we've got our 1-for-1 movement with the underlying share. So we've got exactly the same exposure, and our investment is 5 cents a share. Now you do the math, okay? So would you rather be investing $50 or $30,000 in exactly the same exposure? Okay. Now, we're going to protect this for 2 reasons. First of all, we're going to protect it because we like the idea of protecting it. We're going to protect it right through to June. And because we have got 1-for-1 exposure to the underlying share. So if it goes down, we want to, it'll go down 1-for-1 as well as going up 1-for-1. So we want something in place that's going to protect us. So if we had a $29 put in place, then that would mean our maximum risk is $1 per share. Okay, so this is going to cost us $1.20 right through to June. So our total investment in the position for a protected share position, protected synthetic share position, is $1.25. You all liking this? You start to get it? Now, because we've got a bought call, what that means is we can sell calls over the top of it, shorter term, on a weekly or monthly basis. Now, I've made it simple. We've just gone to January, and we'll make 29 cents on a January 31 call, so slightly out of the money. And so that's 23% return on investment, and that's just month 1. So if it does nothing between now and January, we made 23%. If it goes up, we're going to benefit from the movement of the bought call, the long-term bought call, and the long-term bought put. And so we can be mercenary about it and close it out in January if we want to. So there's several approaches to this, which is obviously part of the learning, that we can use. So this idea of a leveraged synthetic covered call is hugely powerful, and I'm not aware of anybody else teaching this. So you've got a chance now to just do a little bit of learning and see if it could be for you or not. Just a quick poll, just to see where you're at with this. Just to see if I've put something in front of you that might be of interest. So again, just click. I'll assume you don't answer you're not interested in that, but as I said, perfect. Thanks again. Okay, it looks as though there's a reasonable amount of interest in this, in what I put in front of me. Right. Okay, so now we've covered quite a bit of distance on this, and so what we're going to do is what I've asked to do is put something in front of you that was completely compelling. It's that would sort of appeal to all of you, irrespective of experience, but also give you something that's really spectacularly good, and will help you moving into 2016. That's in terms of putting something in place which may make a difference for your next year's trading. So first of all, there's an on-demand course which you can access now. Okay, so there's 2 hours of learning. We're going to revise weekly credit spread trading, how to avoid the 5 key mistakes, all about the Hawkeye wide band. For most of you who don't use Hawkeye, which I assume is the case, how to use common indicators to give you exactly the same entry, and all the trading rules for that strategy. Okay, so that's entry and exit. Also going to cover in that 2 hours of learning, matching strategy to market, how you can create a system to help you in this crucial part of your decision making. So whatever you're trading, whatever option strategies you're trading now, it's going to help you do that. Okay. Now, Those of you who are already members, and I know there's a few on here, we actually are going to run an additional session for you next month, which is going to really nail this down. Beyond the, if you like, beyond the starter information, beyond the basic information. So what's your emails for that one? On top of that, my favorite indicator course, I'm going to give you a choice of attending 1 or 2 live webinars, which are going to run on the 28th and 29th of December. Now, these are both recorded, but it's always best to get there live because I've got a chance to answer your questions. If you're new to options and need a refresh, there's what I'm calling a Kickstart session. So this goes back to basics. It goes back to what options are all about, how they're priced, how to trade directionally, and what sort of things to look at when creating a trading plan. And as part of that, I'm going to actually give you a trading system that I use for bought calls. Okay, that's part of the reward, if you like, for investing some time in that session. For those of you more experienced, or if you really like the idea of looking at 2, there's going to be a shares no money down session. And I put a question mark because sometimes it's a few cents, as we've seen. Okay, and we're going to look at that explosive strategy I talked about in more detail. So we're going to look at all of the things that you need to know if you want to be safe and maximize profit in this particular strategy. We're going to look at the different approaches we can take and 3 or 4 things that will really blow your socks off in terms of how we can adapt this strategy once you've learned the basics to really make it rock and roll for you. And finally, the final thing in terms of the package is probably, in my eyes, is probably the most important of all for many of you. As I've already said, we run a Trade Alert portfolio service which also has education of all of the strategies that we use and some downloadable trading plans, etc. So I'm going to give you access to this over Christmas and well into January. The Trade Alert, the portfolio service, the daily emails which update all of the positions in the portfolio. So you're going to get an opportunity to that and to connect with me on a regular basis for the next hour only. So that's for a full 30 days. Now, normally that will cost $97 a month. If you want to proceed after that time, then all you have to do is do nothing really. If at the end of the 30 days you decide it's not for you, so then just let us know. There's no lock-in for months and months and months like some do. There's no lock-in, so just come in, have a look, decide whether it's for you or not, and then let us know. So hawkeyeoptions.com/start will get you access to those 3 things. My favorite indicator, access to both of the live webinars, the Kickstart and the No Money Down session, and full access for a full 30 days. We're normally now only offering 2 weeks to the Trade Alert portfolio and education service. So that's what I'm going to share. It's only $47, and look, why wouldn't you for that small investment? I'm going to just have a look through the questions now. I'll leave that open so you can get enrolling. But let's just have a quick look at the questions and answer. What do you do for your long? Right. Okay. What do you do for your long put strike? Usually we place it quite close, but on that session, Julie, we're going to cover that in detail and the advantages and disadvantages of moving it further away or even higher than the calls, the bought call sold put level. So we'll actually give you scenarios in terms of what that means with your investment and the pros and cons of each particular strike price placement. Strike price placement is pretty key to getting this, and it's one of the reasons why a little bit more information rather than just diving into this as a strategy is very, very worthwhile. Do we roll the shorts if it gets too scary? Not sure what you're referring to there. If we're rolling we can roll the whole position. That's another strategy we can use for another 6 months or for another year if we want. Some of that depends on the liquidity of the option. But again, we're going to cover that in detail. We can, one of the things we have to manage is margin requirement. If we sell a calls below the level of the bought call, again, we talk about how to manage that and how to keep an eye on making sure that you've got enough to make decisions on based on the underlying chart, the underlying stock, but also rather than worrying about margin to make your decisions on, there's ways to manage that, which again we're going to reference in the session. 28th and 29th of December, and as I said, these will be recorded if you can't make it live. So don't feel as though you have to, if you can't make it, that's all good, because you'll get access to that going forward. The trading alerts come as part of that $47. Yeah, so for 30 days from now, for those of you who are doing the business and enrolling in the next hour. After subsequently, as I said, it's $97 subscription, which is no lock-in. Within that, we get you get 2, depending on the market conditions, but generally 2 to 4 new alerts a week. And obviously, within those alerts are entry criteria. If they're entered into if they meet those entry criteria related to price and time, then they'll be entered into the portfolio, and you'll get the chance to track them with us. So if you're like standing on or sitting on our shoulders watching exactly what we're doing with the trades, they're low intensity trading. It's low intensity trading. We tend to make most of the decisions out of market. We do that simply because it gives people a chance to see how we would trade that particular style of trading. So you'll receive that email, that portfolio update with all our stuff updates, etc., before market open every day, as well as the new alert if there is one. Obviously, sometimes we make the choice not to put a new alert up, and that really could be for one of 2 reasons. Either we feel that there's something happening in the market which means that it would take a step back, which is as active a choice as putting a new alert up, or it may be that we're looking at the portfolio that we've got, which is the other thing that you learn along the way. Looking at the portfolio we've got, is it appropriate to add another position to the existing portfolio we've got? At this stage, we've got 2 diagonal call spreads, we've got no directional trades, and as I said, we had a credit spread expire to maximum profit on Friday. We're going to have likely to be a butterfly trade tomorrow for your time. And ongoing education, absolutely, as part of that, we have a weekly webinar session which all members are welcome to join, which again is recorded. So that gives you a chance to pick my brains, gives me a chance to know exactly where you are, so we can put the things in place that you need to move yourself forward wherever you are. And of course, you've got access to support via email as well. If there's any burning questions you've got, then we're more than happy to take emails and that sort of. Then going forward, it's $97 a month if you choose to. So if you subsequently decide at the end of the 30 days or before the end of the 30 days that it's not for you, then just drop us a line saying, not for me, thank you. And obviously, if at any time subsequently you think, right, I've got what I need from this, then again, all it takes is a notification and it's switched off. So it's not a lock-in, at all. The chat room, Francis, we use the webinar as essentially a chat room. We more often we have looked at looking at a Skype chat room, which we're looking at potentially to start towards the back end of January. Certainly that's something that is very much on our agenda for next year. I see advantages in that. Already a Hawkeye starter kit member. Will you connect the 2? Okay, Robert. Look, yeah, I think that by that I'm assuming you're already in a trial, and I don't see any problem with you coming along to the webinars and getting access to that. Just drop me an email at mike@hawkeyeoptions.com, and I'll make sure that that all is in place to make sure that you can do that. Good man, good man. Excellent. Okay, guys. Well, look, I think I've answered most of your questions. For those of you moving forward, and as I said, it's almost a why wouldn't you for what we're offering here. I really look forward to working with you on the other side. For all of you who have invested your time to come along and listen to what I've had to share, my sincere thanks. Best wishes for the festive period to you and those that you care about. I hope the Christmas shopping doesn't drag you too nuts, and have a wonderful time with family and friends. It's always a pleasure and a privilege sharing this time with you guys, so thank you. Take care, trade safe, and learn with passion, because it always makes a difference to your results. My name is Mike Smith. Catch you again soon. Bye-bye for now.